Ever wondered why some businesses thrive while others struggle to stay afloat? Or why your paycheck never seems to stretch as far as you'd like it to? Today, we're taking a deep dive into the world of finance. And I promise you, it's far from being as dry as it may sound. We're here to demystify the complexities of money, from the distinction between profit and cash flow to uncovering the hidden factors that determine a company's true value. So, fasten your seatbelts because by the end of this video, you'll have the knowledge you need to make more informed financial decisions and establish a strong financial foundation for your future. Let's dive right in. So, what can the world of finance offer to everyday folks, business owners, and investors? Well, let's explore 5 key concepts that will empower you to make wiser choices and grasp the world of money more comprehensively. Concept number 1. Profit is not the same as cash flow. Picture this, you're a creative genius with groundbreaking ideas. You've developed a game-changing product and crafted a prototype. However, your expertise lies in innovation, not in manufacturing or sales. So, you decide to outsource the production of your product to experts who can deliver according to your specifications. They manufacture your product, send it to you, and you pay upon receipt. Similarly, you hire someone else to handle the sales of your product. You ship your products to a retailer. But here's the catch. They won't pay you immediately. You'll receive payment in 30 days. Now, let's say that this month, you purchase 100 units at $80 each and sell 50 units at $100 each. You might think you've made a profit, right? Well, it's not that straightforward. Your revenue is $5,000, 50 units at $100 each. But the cost to product those 50 units was $4,000, 50 units at $80 each. So, your profit stands at $1,000. $5,000 minus $4,000. But here's where it gets tricky. Your cash flow tells a different story. You haven't received money from the retailer yet, leaving you with $0 in cash inflow. However, you've already disbursed $8,000 to your supplier. That's a negative cash flow of $8,000. So here's the takeaway. Profit occurs when a sale is made, but cash flow is the money that actually lands in your pocket. It's entirely possible to be profitable and still face a cash crunch if you're not vigilant. Therefore, it's crucial to monitor both aspects to stay financially afloat. Concept number 2. Every financial statement is like a chapter in a financial book. Imagine these statements as different chapters in a financial storybook. The balance sheet, like the book's cover, reveals what you own, assets, on the left and what you owe, liabilities, on the right. The income statement serves as a chapter explaining your earnings, revenue, minus all expenses, ultimately determining your profit or loss for a specific period. Think of it as adding up how much you earned, sales, and subtracting what it cost you, expenses, to arrive at your income. Finally, the cash flow statement is like a documentary, portraying the flow of money in and out throughout the year. It commences with the cash on hand at the beginning and meticulously accounts for every dollar that enters and exits, concluding with your cash balance at the year's conclusion. In essence, these financial statements are like distinct snapshots and films that unveil the financial narrative of a business. Concept number 3. Now, envision that you're contemplating purchasing a company. There are 2 ways to determine its value. First, there's the book value, akin to browsing through a company's historical financial records. It details the assessed value of all the company's assets on paper. For instance, let's take Apple Incorporated. On March 30, 2019, their book value was roughly $106 billion. When you divide that by their outstanding shares, which amounted to 4.7 billion, you arrive at approximately $22.55 per share. But here's the intriguing part. The second method is the market value. This is the actual price that individuals are willing to pay for the company. In early May 2019, if you checked Apple's share price, it was hovering around $200. So, what sets these 2 values apart? Well, the book value is like scrutinizing a company's past, while the market value hinges on investors' expectations regarding the company's future performance. It's akin to comparing a company's history to the potential it holds in the days to come. These two values can often diverge significantly. Concept number 4. Expanding your operating income offers various avenues for growth. CEOs and CFOs sometimes become fixated on a single strategy, reducing expenses repeatedly. Although this can be effective, there are alternative paths worth exploring. Firstly, consider your pricing. Are you charging customers a fair price that reflects the value you provide? Next, contemplate increasing your sales volume. Are there opportunities to sell more of your products or services? Thirdly, evaluate your product mix. Can you allocate more resources to selling higher margin items instead of lower margin ones? Efficiency is also vital. Can you maintain the same output with fewer resources or even enhance output with the same resources? Examine your relationships with suppliers. Can you negotiate better terms or uncover superior deals elsewhere? Lastly, investing more can yield substantial returns. Allocate resources to research and development to enhance your products. Invest in marketing to bolster your brand, and devote resources to employee development. These strategies can all propel your operating income to new heights. Concept number 5. Picture this scenario. You have the option of receiving $100 right now, today, or waiting an entire year to receive that $100. Which would you choose? Most likely, you'd opt for the $100 today. And that's a savvy choice. But why? Well, consider this. A lot can happen in a year. The individual who promised you the money might have a change of heart, or worse, they could encounter financial difficulties, rendering them unable to fulfill their promise. Furthermore, there's the notion of inflation, which implies that the value of $100 could dwindle over time. This concept is known as the time value of money. It underscores the fact that $100 today holds more value than $100 a year from now. Now, imagine I ask you, what's the smallest amount you'd accept to wait an entire year for that $100? You might respond, give me an extra $5 and I'll wait. In essence, you've assigned a price to time. Consequently, $100 today is effectively worth $105 a year from now. This encapsulates the essence of the time value of money, recognizing that the worth of money fluctuates over time. So there you have it, folks. We've embarked on a captivating journey through the world of finance, shedding light on the secrets that enable businesses to prosper and individuals to make astute financial decisions. From understanding the difference between profit and cash flow to deciphering financial statements, we've armed you with the knowledge required to navigate your financial future successfully. Now, it's your moment to shine. We're eager to hear from you. In the comments section below, share which of these finance concepts surprised you the most or offer your own valuable finance insights. Don't forget to tap that like button and subscribe to ensure you receive a steady stream of financial wisdom directly to your inbox. Remember, the path to financial success begins with comprehension. So keep learning and keep growing. Thank you for joining us here at Kountin Koins. And until next time, stay financially savvy.